When Lehman Brothers Holdings collapsed 6 years ago, triggering the onset of the global financial crisis, David Levy made a prescient call in the pages of Institutional Investor, predicting what he called a contained depression of stunted growth and chronic unemployment as Americans worked to trim their massive debts. Levy, chairman of the Jerome Levy Forecasting Center, shares his views on today's global outlook.
There are a lot of people who make the point that corporate leverage and household leverage are lower than they were going to the last cycle, and claim that we're now healthy, ready to rise again. If you look at the long history, this is really not a very sensible conclusion. Corporate debt relative to corporate GDP, and I'm leaving out the financial sector, is not only back above where it was going into the last recession, it's at an all-time high. Household debt ratios, debt to income, has come down significantly as a lot of mortgage debt was written off, but it's still about where it was in the last business cycle, which was an all-time record at that point, about 2003, 2004. I believe that the economy is at risk of a recession, not because we have an immediate threat coming from within the U.S. economy, although we would if interest rates started to rise, but rather because the rest of the world is in much worse shape than we are, and there are secular changes that are starting to happen that are going to have major cyclical impact. Specifically, the emerging market sector followed for 10, 20 years, depending which country we look at, a model of growth that was very powerful and completely unsustainable, based on building capacity to export more and more to the rest of the world, so that they're not only accounting for the growth in the global economy, but taking bigger and bigger market share. When that trend could not continue, it broke in 2008 and was never able to recover. We have seen a massive pileup of excess capacity, financial obligations associated with that capacity, and we're just starting to see the early signs of investment breaking down in the emerging market. I think, broadly speaking, we are in a period of secular asset price declines, but against that, we've seen a very powerful cyclical rally coming out of the last cycle. So we've seen housing prices in the United States come back fairly sharply, although nowhere near where they left off, but they're up to historically high levels. If we look at, for example, Robert Shiller's Real Home Price Index. If we look at the stock market, I remember in 2011, people claiming that stocks were the cheapest they'd been in 23 years. And that was true based on price earnings for the S&P. But the problem is that that entire period, 1990 on, had elevated valuations compared to earlier history. We are moving, I think, to a period that's more like the post-war period, with more conservatism, more concern about deflation, more concern about capital loss. Although cyclically, the swing has been a little bit the other way in especially 2013 and 2014 today.